Hey everybody, Justin here, and welcome back to the channel. Today I'm going to be going over risk versus reward, how to maximize your reward while minimizing your risk and beating inflation. In today's society, the typical American, I would say, thinks that inflation per year, on a per year basis, is about 2 to 3%. However, life is unpredictable, and if this past year or two has shown us anything, it's that inflation can get out of control. So we need to learn how we can beat it or stay on top of it so we're not losing value in our money. In October, it was reported that the consumer price index rose by 6.2% from a year ago. This is the most since December of 1990, with the annual core inflation, which they take out like volatile food and energy prices, which really helps make the number look not as bad as it truly is. But that was reported at 4.6%, which is the highest in 30 years. A 6.2% increase in CPI is being generous. The following is a list of items that skyrocketed over the last year or two. The average home is up over $60,000. Lumber went from $4.30 to about $11.30. Gasoline in October was up over 50% compared to last year. Used cars are up 26%, and new cars are even up 10%. Beef rose by 20%. Poultry, fish, and eggs are up by almost 12%. Fuel and oil prices rose by almost 60% over the past year as well. Now, a 6.2% inflation rate seems bad, but with all these listed here, it shows you how much worse it truly is and how much your pocketbook has been hurting. Inflation can get out of control, and what we need to do is take some risk with our money to stay ahead. When talking about taking risk with our money, how risky are we talking? I'm gonna break it down for you from some, low risk, low reward scenarios, high risk, high reward scenarios, and kind of where I feel like the comfortable medium is. On a scale of 1 to 10, the least risk you can have with your money is putting it into a traditional savings account. With the average return of 0.01% per year, those returns are abysmal, and inflation will just eat away at all that you have saved up. Savings accounts still should be utilized for short-term savings that you're saving away for larger purchases or an emergency fund, but other than that, putting your money in there is just losing value day after day. Savings accounts are extremely safe. This is why I gave it a 1 out of 10 on the risk score. I feel like it's even safer than stuffing cash under your mattress. The reason for this is all banks are insured up to $250,000. So if something were to happen to the bank or institution, the government has backed those banks and credit unions as well, guaranteeing up to $250,000. If you want to bump up a savings account to a 1.5 on the risk versus reward scale, what you can do is you can invest in a money market account, which will give you slightly better returns, on average about 0.25% per year, which is definitely better than a traditional savings account, but still not enough to beat inflation, and you're still over time gonna lose value on your dollar. Other low risk items are gonna be bank CDs, treasury bonds. Those are gonna be lower on the percent return, in just a couple, I would say anywhere from 1 to 3% traditionally. And as the stock market changes and stuff, those prices can fluctuate, but they're still gonna be, low reward, and the risk is definitely lower as well. If you're looking for massive returns and taking some massive risk, another option could be going all in on a single or a couple individual stocks in the stock market. Doing this through a brokerage account, you can make massive returns if you bet right on that company. If you put in 90% of your cash into one stock and it goes up 10%, you're making a killing. However, if you put 90% of your cash in a stock and it can easily just as well go down 10%. And if you're looking at volatile options, which is where you can earn the most reward, but you take some of the most risk as well, you can really fluctuate how much you earn by investing a lot of capital in those. So be wary of this option. It is very high risk. It could be high reward, but it can really come back to bite your cash flow. if you think that inflation is killing your dollar, losing all of it is going to do a lot worse than inflation. Other high risk options could be investing in a small business or a business opportunity that a friend has that they almost guarantee you high rewards. So do your due diligence in those. I haven't gotten involved with that because I like to, play safer with my money than that, but do your due diligence and see if the risk versus reward metric is met in your head, and then go and do what you want with your money. The sweet spot in my mind is a diversified portfolio of stocks, not being over leveraged in one stock. The best way to mitigate this is by not having more than about a 5% stake in any one stock. If you want to further benefit from diversification in the stock market, look at index funds and ETFs. These funds are great. They actually are made up of 100 to thousands of companies in the stock market as an overall whole, and help track the market for you. And that way you're not over leveraged in a single stock. When you're investing in an index fund or an ETF, you're investing in, hundreds of different stocks. So it's a lot easier to just throw your money into it and let it ride than it is to manage it constantly for yourself, or have someone else, or pay for someone else to manage it for you. You can just throw your money into a few different index funds, such as, VTI, the S&P 500 index, and a Vanguard has an index as well. Those are great metrics for you to track. A diversified portfolio is a great option. If you want to further diversify your portfolio, you only have to invest in the stock market. You can invest in real estate as well. That's another great option, and it can be a cash flow positive investment. Historically, housing has netted a 6 to 7% return, so that is another great option for you to add to your diversified portfolio. I would also recommend not to be over leveraged in that, because if we were to have a housing market crash and you're over leveraged in real estate, then you're gonna see a major hit to your portfolio. So make sure we find that sweet spot. We don't want to be too risky with our money and lose it all. We don't want to be not risky at all with our money and then just get killed by inflation and lose value in our dollar. We want to find a good sweet spot, invest, and maximize our reward. We take risks every day, so being risky with your money is okay. We take risks when we're driving to work. We're driving to work to make money, so we're taking that risk of driving next to a bunch of people, risking getting in an accident in order to work and make money. That's the same thing here. We're taking that risk to invest in a stock portfolio, a diversified stock portfolio, in order to make money. Otherwise, if we don't drive and we don't work, then we're not making that money. Long story short, minimize your risk, maximize your rewards, find the sweet spot, and help build your financial future.